Hey guys, Joel Frank here, market analyst for YouTrading, and today we're going to be just giving a quick market update, looking across the different asset classes, updating on some of the key events and key themes of the week. So let's jump straight into it by taking a look at the US Consumer Price Index figures, which were just released for the month of June, basically giving us an update on the state of inflation in the US economy. This has been highly anticipated, this data release. And it has been, it definitely is the most important data release of the week. Obviously, we do have some important US numbers coming out on Friday as well. But for now, let's just focus on what the inflation numbers in the US were saying. And pretty much, to put it bluntly, things were ugly and inflation was hotter than expected. Okay, so you had the year-over-year rate of inflation rising to a new 4-decade high, 9.1% in June versus June 2021. That was above the expected 8.8% and above last month's 8.6%, which was also a 4-decade high. So that is a massive jump. Shocking, really. The month-over-month pace of inflation, 1.3%, which is also just shocking, to be honest. Like, we were expecting a rise to 1.1% from 1% last month, but yeah, things are not looking good. Now, these headline numbers are being boosted by energy prices, which gasoline rose to record highs in June in the US. So a lot of people were hoping there would be some respite or some signs of easing price pressures in the core data. Now, that didn't really seem to be the case. Okay, the year-over-year pace of core CPI fell to 5.9% from 6%, but it was still significantly above expectations for 5.7%. And the month-over-month pace of increase in core prices accelerated to 0.7% from 0.6% last month versus expectations for it to remain at the same pace. So across the board, these inflation numbers are not good. And there was, going into these numbers after strong jobs data last week, after strong ISM data from services manufacturing sector data last week as well, there wasn't much doubt that the Fed's going to go with a 75 basis point rate hike at its meeting later this month. And this inflation data means it's just certain at this point. There's definitely going to be a 75 basis point rate hike. Do you know what? Given these inflation numbers, I wouldn't be surprised if people start to now talk about a 100 basis point rate hike. I mean, these numbers are bad. Like, you can see them in front of you, 9.1%. And, you got price increases of 1.3% in 1 month. Like, the Fed is going to be very, very worried looking at these numbers. But we're not just talking about bigger rate hikes this month. We're potentially talking about bigger rate hikes in September too, because before this data came out, the sort of consensus was that there'd be a 50 basis point rate hike in September after the 75 basis point rate hike in July. Well, 75 basis point rate hike in September might now be on the table. I mean, I wouldn't rule it out, seeing these numbers. And markets are probably going to have to price in a higher terminal rate, which is likely to be at some point in 2023, like the highest point that the Fed takes interest rates as well. Because inflation, the Fed was hoping by this point of the year would have showed signs of coming down, but it just hasn't. So, where's inflation going to be at the end of the year? It's still going to probably be pretty high, and the Fed's still going to have to be putting its foot on the brake by raising interest rates to cool the economy, basically. So, yes, that's the data. Not looking good on the inflation side. Very, very hawkish implications for the Fed. So let's look at markets. How have they been reacting? Okay. Well, euro dollar for now still just holding above that parity level. But let me just show you on the 1 minute chart so I can show you that there actually was a reaction. That was the spicy inflation data. So we did see a big drop. But this one parity level seems to be a bit of a barrier at the moment. But I think most people expect that parity is going to go today, tomorrow, this week, in the coming weeks. It's got to go at some point, because one of the major themes this week has been fears of a recession in Europe amid uncertainty over whether Russia is ever going to reopen Nord Stream 1 pipeline. Remember, the Nord Stream 1 pipeline's closed for 8 more days, I think now, for planned maintenance, but a lot of people think that it's not going to reopen, and a load of the governments, like the French government's preparing for it not to reopen, the Germans are prepared for it not to reopen, and they're all warning about a recession if it doesn't reopen over the winter, because they're going to have to basically ration energy, close down industry in order to prioritise heating for homes, basically. So there's a lot of risk for the euro at the moment from these kind of geopolitical and economic things, and I thought maybe this would be a nice trade if euro dollar came back up to this area of resistance, and then you could sell it again and ride it lower, but maybe we're not even going to get the chance for that. If I zoom out a bit more, let's go on a, not 1 minute, 1 month candlestick, maybe in the coming sessions we get a retracement to this high from July 2002, which is around 102. And now if we just zoom back in again, maybe you could sell it there and then ride it lower. But this could just go. This parity level could just go, and then the level we're going to want to be looking at, I think, is around here. This is 0.96 because you got these highs here from July 2000. January 2001, and then these lows here from July and August 2002. Okay, so that is the next target for me. Let's look at other asset classes. S&P 500. What are we thinking? I've already got some technicals here, that's good. Yes, so there was this uptrend, tentative uptrend that we were following that we seemed to break yesterday, definitely broken it now. Definitely seems as though the S&P 500 is going to test this support here at 3,750, and if we do start talking about some of the things I just said, 100 basis point Fed rate hikes, 75 basis point in September, then I think there's nothing really stopping us from testing these yearly lows and even pushing lower, to be honest, because this index has been in a bearish trend line for some time now. Like I showed you at the start of the week. But I'll show you the bearish trend line now. Pretty much something along the lines of this. So really, from a technical perspective, you could be talking about 3,400 at some point in the next couple of weeks. What about oil? Let's have a look at oil. Kind of a similar story, really. Like we're still, WTI, we're convincingly below 100 now. We did just print fresh multi-month lows, actually. If I zoom in, I can show you that there was a slight negative reaction to the inflation data. That was out here. There you can see, although we've mostly recovered now on an intraday basis. But if we're going to have a risk-averse market where people are fretting about recessions and Fed tightening too quickly, and with energy and with oil, you've got things to worry about like Chinese lockdowns, as coronavirus cases have been rising this week in China. And I was reading something earlier where it was talking about how 31 Chinese cities have now under lockdown in some way, up from 11 1 week ago. So there's a lot of threats to demand out there. We still do have a tight supply backdrop because of obviously the geopolitics and OPEC not pumping as much as, well, they can't pump that much more at this point really. But if we are going to have a big global recession, then it does seem likely that we can go under this support level here from March and April, and continue in this trend line lower, unless something big happens, in geopolitics to change the mood. Like, no one really understands what's going to happen with if the EU and other countries do put a price cap on Russian oil. How's that going to affect the market? Is that going to reduce the price of some oil but make other oil more expensive because it discourages Russian production? Like, it's going to have to remain to be seen. Like, how do you even implement that policy? So there are still uncertainties that can support oil, that are oil specific. But anyway, yeah, guys, that is pretty much a look at the markets. We still do have some things we need to be keeping an eye on for the rest of the week. Let me just pull up the calendar and we can talk about them. So actually, in quite a short time, at the time of me recording this video, we've got the Bank of Canada doing a rate decision. They're expected to do a 75 basis point rate hike, pretty much following what the Fed did last month. Obviously, the Canadian dollar traders will be watching that. Then we've got Aussie jobs data, which is expected to be strong. Probably won't underpin the Aussie that much, though, because the Aussie's more focused on these. We've got falling commodity prices globally. We've got worries about Chinese lockdowns. We've got worries about a global recession. And the Aussie is exposed to, trends in the global economy, and it's risk sensitive, so probably won't help it that much. Then we've got PPI tomorrow, which, we've had the CPI now. We know that US inflation's bad. Some Fed speak. How do they react to the latest CPI data? That will be important. This might be where we start getting that chatter about bigger Fed rate hikes. Chinese GDP, that will be important for general risk appetite, and especially for the likes of the Aussie and the Kiwi. And then US retail sales data on Friday, and preliminary consumer sentiment data out of the US as well. Those will be interesting because those will basically tell us how badly the consumers in the US are being battered by inflation, basically. And some people are hoping that if these numbers here get ugly enough, then that could deter the Fed from tightening. But the thing is, this is a Fed that's very much prepared to bear a recession if that is what is required to deal with inflation, because their priority is tackling inflation. Because if they start easing now, the US could, high inflation at the current levels could become embedded, and then the Fed will have completely failed in its mandate as a central bank, which the number one thing is price stability. Obviously the Fed has to do the unemployment rate, try and keep that low as well. But yeah, with inflation at these levels, I think it's too soon to be talking about the Fed easing because of weak growth. But anyway, guys, that's the rest of the week. Trade lightly. Hope you enjoyed the video, and I will see you all in the next one.